We are a vessel valuation and market intelligence provider. The main thing that we do is we value every vessel in the global fleet every day. So daily updated values for 60,000 odd vessels, it's market values, discounted cash flow values, forecast values, demolition values, replacement values, and much more. In addition to the valuations, we do market intelligence such as ton-mile demand, trade flows, vessel tracking, transactions, ownership relationships. So it's really a one-stop shop for all your shipping market intelligence needs. We're about 150 people worldwide, and we work with about 400 companies around the world, really the major shipping lenders, investors, owners, regulators, and traders are our clients. We all know the shipping markets are very volatile, and volatility has continued, but we are certainly in a time of renewed optimism. The different sectors are showing different performance, but we are looking quite optimistic for values and rates across all the major sectors until about 2020, 2021. If we go look at bulkers, this is the market that in the last year, 18 months, has really been on fire, right? The sentiment has really returned. Values have come up a lot. In March 2017, Capesize values, 5-year-old Capesize values increased by about 40% over a 1-month period. Over the last 1 year, 18 months, values are up between 50 and 100%, depending on the age of the vessels and types. It's actually the smaller, older vessels have done the best. So the small handies, the Supramaxes of the 10, 15, 20 years old have shown, 110% increase in value, really because they have been so maligned before, their values were so low. The distressed nature of the market and this improvement in sentiment and the market in general has brought those values up. So they've done very well in the last year, and we expect them to continue doing well over the next couple of years. We're looking at about a 30 to 50% increase in value, depending on the different sectors and ages, over the next 2 to 3 years. Containers, we've got a bit of a similar story there. Containers were in a really, really bad place until about a year ago. You remember 2 years ago with Hanjin bankruptcy and so forth, values had really come down. In the beginning of 2017, we had a 2010 built Panamax container vessel sent for demolition. That's 7 years old, right? Those values have basically doubled in the last year, right? The market's really come up. Not to say that they're particularly high, they're still way below the long-term historical average, but the market has really improved, basically due to improved demand fundamentals and thankfully a reduction in the ordering and a slowdown of the fleet development. So demand is outstripping supply. That's caused rates to increase. I know they've dropped off recently, but increase in general, and values to follow. So done well, and like the bulker sector, we are particularly bullish. And the sector that we're really bullish on is the Panamax sector, and we're looking over the next 2 to 3 years at about 100 to 150% increase in value. But this is still from very historically low levels that they still are at today. Tanker has not done so well. In the last couple of years, the rates have been in a really bad place, pretty much across all the types below, at or below operating cost. We have recently, in the last week, had crude tanker, particularly larger crude tanker, VLCC and Suezmax rates increased significantly. VLCCs went from about $15,000 a day to $40,000 a day over this week. So that's helped with the sentiment. But even before that happened, we have been expecting a recovery in the tanker sector to start early 2019, particularly in the crude sector and some of the larger product tankers as well. We're a little bit less excited about the MR sector just because of the continued excess supply of the vessels. So we're expecting the next 6 months to be pretty flat in values. And then early 2019, we're expecting a recovery and values increasing through 220, 221. The final thing I just want to say on the markets in general is that this is all looking quite rosy, but we are forecasting another downturn in values and rates starting in 2021, and that's really for two reasons. We're expecting demand to come down due to a generally expected global economic slowdown in around 2021. This is just a cyclical thing around the world. We're expecting to have too many good days before then, and cyclically going to expect this a fall in GDPs and so on, or fall in the growth of GDPs. And at the same time, if we're expecting the shipping markets to be good between now and then, those good shipping markets will result in increased ordering for vessels. So we're expecting supply to increase, and we're expecting in 2021 demand to potentially fall, and those two factors together may lead to another cyclical downturn. I'll start with the gas market. Obviously, the gas market splits into two main sectors, LNG and LPG. This is a market that us at VesselsValue have always been very positive on. We really like the gas sector for a couple of reasons. The fundamental underlying demand story is very good. There is a desire for the world to burn cleaner energy, and we're seeing a lot of countries, Japan, China, and many others, really putting a government mandate to increase energy production through clean fuels, and one of those clean fuels is LNG. So, basis that, we like it. We really think there's a future for gas. If you look at the future potentially for tankers, it's maybe a little bit more concerning. We're seeing hopefully a reduction in petrol and diesel consumption, but we're hoping for increased LNG and LPG production. So that's a good point. The problems in those markets is the problems in all the shipping markets is we've built too many vessels. So we've had an oversupply, and that's really calmed the market down. So in my presentation I did earlier this week, I was talking about gas vessels, saying that the market should be hotter, but it just isn't there yet. Part of the demand story as well has been delayed because a lot of these LNG production areas have taken more time, have been delayed to get online. So we like the demand story. The supply story is a problem. What's happened with values is generally they've been flat to slightly down over the last couple of years, but we are expecting, similar to the tanker sector, we're expecting an improvement over the next 1 to 2 years going forward. Offshore is a totally different story. Offshore is in major distress at the moment, particularly the commoditized offshore vessels such as platform supply vessels and anchor handling tugs. These values are down 70, 80, 90% from 2014-15. There are some bright areas. The subsea maintenance vessels for maintaining the platforms, the accommodation vessels, they still have pretty good demand, pretty good utilization. The jack-up rigs, while the utilization isn't great, the values have actually increased over the last year due to some buyers out there snapping up some of these vessels on an asset play basis and driving up the prices. But generally, how I like to define the offshore sector is it's hungover, right? There was too many good days, and we are now reaping the problem from it. Too many vessels, not enough demand equals terrible utilization and terrible rates.